Ajay Argal, Head of Indian Equities with Bearing Asset Management, who joins us from Hong Kong now. Ajay, good to have you back. Thank you for joining us. Ajay, first a word on the global picture. 2 weeks ago, when yen strengthened against the dollar, everything, the global risk-on trade was coming under threat. But currently, even though Japanese yen is sitting at a fresh 1-month high, globally things are holding on quite nicely.
Yeah, so the risk appetite is a dynamic thing, and it obviously the currency prices are relative prices, so how the currencies are valued against each other is what they are indicating, and that obviously is one of the parts there is the expansion of the balance sheets of the various major economies. And as we have seen over the last several months or maybe a few years, that most of the major economies around the globe are willing to expand their balance sheets. And at various points in time, different major economies do that. And whenever that happens, that particular currency depreciates. And that is what we have seen with the yen, that over the last 6 months or so, the Japanese central bank have indicated that they're willing to expand the balance sheet at a much faster pace and at a much larger amount compared to what people were thinking earlier. And that's why we have seen the yen depreciation. So the thing is, as far as the liquidity is concerned, it's ample around globally. And once that liquidity is there, it has to go into certain assets. And when we are seeing that the global bonds are already very richly priced and they've done so well, and the yields were at rock bottom a few months back, then there will definitely be money flowing into the equity markets as well, because in relative terms, they are not as expensive as they used to be a few years back.
Ajay, so what's your sense about, clearly there are fears prevalent that quantitative easing may be tapering down now. How do you think that's going to impact flows coming into India?
So it's a very complex structure, so it's not as simple or as black and white that if the QE tapers off, then it will be bad for India. First of all, it is not yet clear when the QE is going to taper off. So if you look at the employment numbers in the US, and if even the current employment generation continues at the monthly pace at which it is going on, then even then the QE is going to continue at least till middle of next year. So that is a long enough time for any equity markets, and beyond that anyway, very difficult to look from a flow perspective. So first of all, it is not very clear when and how the QE is going to be taken away. And even if that happens, even then there is the stock of money already is sloshing around the globe, and it is definitely looking to go into assets where the growth is, and certain Indian stocks are definitely fitting that bill. So even though the Indian economy may not be doing terribly well, as we all know, there are always companies and stocks in India which continue to do phenomenally well within the context and maybe even in a global context. So the global money would be looking to get into those kind of stocks even in India.
Ajay, do you think for Indian equities the best part of the summer rally is now behind us? Indian equities appreciated in the month of April and May was largely because of macro adjustment. And do you think the macro trade is reversing once again?
So that's what I was trying to explain a bit back, that we don't look the Indian markets in terms of the macro picture. We are trying to spot opportunities. So we want to be bottom up. We want to look at stocks which can give return. And if you hold on to those stocks for a very long time, then definitely they are going to give you very good absolute returns as well. And we already know a lot of these stocks, if you look at in the rear view mirror in the last 5 years. And there is no reason that you will not find a set of, let's say, 50 or 100 stocks which are going to do the same over the next 5 years. Primarily because even if the Indian economy grows at around 5%, there will be stocks and companies which will be growing at around 20%. And if you're growing at 20% and maintaining margins and maybe increasing it slightly over a long period of time, then maybe you're looking at 25-30% profit growth. And that is the kind of returns you would be getting in those kind of stocks. So that is the primary focus for us, that we want to identify stocks rather than look at the macro picture, because macro picture is very difficult to figure out. There are too many variables, too much uncertainty. The entire global economy is in a flux, and it's going to remain in a flux. So there is no point fretting about it and trying to figure out day-to-day or even month-to-month movements as far as the broad markets are concerned.
So Ajay, according to you, would it be fair to assume that the GDP figure that we had, sub 5%, a decade low, hasn't quite bottomed out and there's more pain left in the economy?
Yeah, so the crucial question is not whether it has bottomed out. The crucial question is how long it is going to stay there, and that is anybody's guess. Your guess is as good as mine, because we think that maybe the GDP growth is as low as we have seen, but whether we are getting back to 7% within 1 year or 2 years, or whether it will take longer, that will decide the kind of returns which we are going to get in the markets and in individual stocks. So that is a continuous process, and we continue to put our attention to individual stocks within this framework, because this is something which is not under your control. So given this framework, what are the best stocks you can have in the portfolio is our endeavor.
Right. Ajay, what has worked in the past may not work in the future. And the classic case here is pharma. Up until now, pharma stocks have made money. But if I look at the recent news flow, which is emanating for the pharma sector, concerns are surfacing up. Ranbaxy's got US FDA problems. Sun Pharma is about to acquire a big company which may destroy its balance sheet. There are problems for DVs and there is a drug pricing policy which has kicked in for MNC pharma companies. As a group, how would you approach pharma now?
Oh, we are still very positive on pharma. So when you mentioned that pharma has not done well or may not be doing well in future, it may not be correct, because some of the names which you took, even some of the actions which you are suggesting, may be actually adding value rather than destroying value. So it's unfair to say that they may be destroying value if a certain company is making a big acquisition. You have to look at the company's track record, and the company you were talking about had phenomenal track record in acquisitions. And the company where you talked about the US FDA issue, I think that particular stock has not done well anyway in the last year as well. So it is, as I mentioned, it is very stock specific. We still find a lot of good companies in the pharma sector. We are positive on the pharma sector because the opportunity is there. In spite of the DPCO, the drug policy in India, you will see 15 to 20% kind of growth for many years for the Indian domestic companies. And even in the US generic market, there are a lot of opportunities even now for small companies, for large companies. And some of the rest of the emerging markets are still opening up and still growing at a very fast pace. So this is where, pharma industry is where the Indian software industry was at around Y2K. So we think that there is a lot of opportunity still in this sector.
Ajay, really good chatting with you. Appreciate you taking the time out and joining us on the show today. Let's quickly